Abbott Equipment leased a protein analyzer to Werner Chemical on September 30th, 2009. Abbott purchased the machine from Nutrilabs, Inc. at a cost of $6 million. The 5-year lease agreement calls for Werner to make quarterly lease payments of $391,548, payable each September 30th, December 31st, March 31st, and June 30th, with the first payment at September 30th, 2009. Abbott's implicit interest rate is 12%, and there are 3 requirements. First, what pre-tax amounts related to the lease would Abbott report on its balance sheet at December 31st, 2009? Second, what pre-tax amounts related to the lease would Abbott report on its income statement for the year ended December 31st, 2009? And third, what pre-tax amounts related to the lease would Abbott report in its statement of cash? In answering the question, what pre-tax amounts related to the lease would Abbott report on its balance sheet at December 31st, 2009, you see the answer appearing below on the image in the lower part of the screen. The initial balance of the receivable was $6 million. The September 30th payment reduced it by $391,548, the full amount of the payment. And on December 31st, we had a further reduction of $223,294, bringing the December 31st, 2009 receivable balance to $5,385,158. On the next slide, we'll show how we derived these numbers and what journal entries were involved. Okay, so the first entry records the lease receivable, and we know that present value is equal to $6 million. The credit goes to inventory of equipment. That's the lessor's cost at $6 million. Then we also receive a payment on September 30th, so we debit cash for $391,548, and we credit the lease receivable in that same amount. On December 31st, 2009, we receive our second payment, so we debit cash of $391,548, and we credit interest revenue. Let's work the last entry first. Since the market rate is 12% and there's 4 payments per year, we take 12% divided by 4 to come up with 3%, and we take 3% times the outstanding balance of the lease receivable, which would be equal to the $6 million less the first payment at the signing of the lease of $391,548. So when we take 3% times that remaining balance, we come up with an interest revenue of $168,254. Then the other credit reduces the principal balance of the lease receivable, and this slide calls it a difference, or you could say it was forced. It amounts to a credit of $223,294. Okay, next we determine what's the pre-tax amounts related to the lease would Abbott report in its income statement for the year ended December 31st, 2009. And you'd need to rely on the information we just explored on the last slide. At September 30th, 2009, there's no interest revenue. That's when the lease was signed. But we did record $168,254 of interest revenue for the next 3 months, and we record that on December 31st, 2009. So that's the full amount we would see on the income statement of Abbott Equipment Company. And finally, requirement 3 asks us to determine what pre-tax amounts related to the lease would Abbott report in its statement of cash flows for the year ended December 31st, 2009. And again, you want to flip back to the previous slides to see where those dollar amounts came from. But lease receivable of $614,842 would show up as a cash inflow from investing activities, and the interest revenue, $168,254, would show up as cash inflow from operating activities. Now, Abbott would report the full $6 million direct financing lease of the protein analyzer as a significant non-cash investing activity, right? They acquired one asset and disposed of another, but there was no cash involved. And that would appear either on the face or in a schedule on the face of the cash flow statement or in the disclosure notes to the financial statements. Now, $783,096 represents the two payments of $391,548. Those are the cash lease payments, and they would be divided into the interest portion and the principal portion. And we know earlier from working this problem, the interest portion, $168,254, is reported as cash inflows from operating activities. And therefore, the difference, which comes out to be $614,842, is reported as cash inflows from investing activities.